It was a solid day for the U.S. stock markets as we saw most U.S. equity indices up by about 1/3%, largely based on some positive news coming out regarding developments with the U.S. and China trade war. We do have Lighthizer and Mnuchin over in Beijing right now for those talks. We've also heard some rumblings that perhaps China is willing to relent a little bit on their forced technology transfer issues. We also saw some good news coming out of the retail space today. We saw Lululemon and PVH up very nicely here today, but we still remain in a little bit of a weekly bearish posture from an intermediate perspective on most market indices. So we'll look at all of that, and then we'll take a look at a trade application example from a stock that's largely gone nowhere here recently and see if we might be able to take advantage of it with an iron condor. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 28th, 2019. First of all, if you're new, welcome aboard. Remember to go to our YouTube channel, click subscribe. While you're over there, go to our description area and sign up for our email distribution list as well. We're also heavy users of Twitter. Feel free to follow me. My handle is @BrandonVanZee, and we'd encourage you to click like and retweet whenever you see us post these Market Outlook videos. In addition to Twitter, we also have a presence on Facebook. Feel free to join us over at our group at the web address embedded in the logo in front of you. All right, with that, let's go ahead and dive into the charts. As you can see, I've got chart 4B pulled up here in front of us, and you're welcome to follow along at home if you are a premium Market Scholar subscriber, as you do have access to all of our 26 plus customized charts here. But remember, this particular chart setup does kind of allow us to look at all four of the major U.S. equity indices, all side by side by side, so that way we can see if there are any differences in any of the indices. And you can see that right now we do have some differences. In fact, you'll notice off to the right-hand side here, we have a darker shading of pink off to the right of the Dow Jones Industrial Average chart and also on the Russell 2000 chart. Whereas on the charts on the left, the S&P 500 in the upper left, it's that lighter pink color, and we have the same lighter pink color down below here with the NASDAQ composite. So the difference between the two is whether the posture is considered weakly bearish or strongly bearish. In the dark pink colors over here, that is considered strongly bearish because you see that these green intermediate line on the market forecast technical indicator that you can find over at the Thinkorswim platform is down below 50 in both of these cases. And remember, you can read these directly in the labels right here if it's hard for you to make that out with a naked eye. So right now it says the intermediate line on the Dow Jones is at 47.53 and falling. So since that's below 50, we do consider that strongly bearish. The Russell 2000 is even more strongly bearish. As you can see, the intermediate line is at 24.25 and falling. So the Russell 2000 is actually getting pretty close to entering the lower reversal zone. It has been by far and away the leading index to the downside. And remember, the Russell 2000 is made up of small cap stocks in the United States, so they are a little bit easier to push around, a little bit easier to manipulate, and you can see that market participants can use that as a little bit of a leading indicator at times. So we would much rather have it be a situation where the Russell 2000 is leading the market to the upside if you're bullish, rather than what we have been seeing here more recently. Also, what is a little bit different is the colors of the moving averages themselves. Notice that the S&P 500 has a moving average color that's currently green, as does the NASDAQ composite. However, you come on over here to the Dow Jones, that moving average is kind of that yellow color. And then down below here on the Russell 2000, that moving average most recently has been red. The differences between all of those is when you have a green moving average, it means that price is above a rising moving average. In this case, this is a 30-day moving average. And when we have a yellow colored moving average like we do over here, in this case, it means price is below a rising moving average. So think of yellow as kind of a neutral or yield if you're thinking in terms of stoplights, where there might be a little bit of difference in what we're seeing. In one case, we have price that's below the moving average, but the moving average itself is still trending up. You can see it the opposite way, by the way, as well, when you see the moving average going down, but price is above that. That would also produce a yellow moving average tip. And then down below here with the Russell 2000, the reason we see that turning red here now is because not only is price below the moving average, but the moving average itself is now falling. So that's what makes this one a little bit different than the Dow Jones. That moving average continues to rise, although it does look pretty flat there, whereas technically we do have the Russell 2000 showing kind of that flattening of the moving average taking place over the recent weeks, but now is starting to tilt down a little bit there. So again, another reminder that the Russell 2000 has been kind of the leader to the downside, or the biggest laggard, however you want to describe that. But as mentioned in the intro, at least we do have some positive results to share for the day specifically. We were up 0.36% on the S&P 500. Same return there on the Dow Jones. We were up 0.34% there on the NASDAQ, and the Russell 2000 was actually up 0.85% there. So strong returns across the board here today, despite still having those intermediate bearish postures that we're dealing with. Let's look at our next chart setup now, and this will be chart 4C, looking at the 3 green arrow analysis here now. And notice that where we stand is a mix of green and red arrows on the S&P 500 and on the NASDAQ. The green arrows still exist on the moving averages themselves, but we do have red arrows on the MACD and the stochastics on both of those indices. Whereas off on the right-hand side here, again, we are seeing that the Dow Jones and the Russell 2000 are our biggest laggards from this perspective as well, because we do have 3 red arrows on both of those indices. We've got a red arrow on the moving average, MACD, stochastics, that's the Dow Jones, and the same thing can be said down below here with the Russell 2000. There's your red arrow on the moving average. Surprisingly, the MACD red arrow has been in effect since February 26th. So that just goes to show you that every time the bulls try to get just a tiny little bit of momentum, the bears immediately tackle them. They're just not letting the bulls have much of a runway there. And then we do have the stochastics with a phantom red arrow that kicked in here maybe last week. So again, same story. Russell 2000 and the Dow Jones appear to be the laggards, and S&P 500 and the NASDAQ appear to be holding up a little bit better. Moving on now to our 1040 crossover method. This is chart 4D for those of you that are following along at home. Now we're transitioning to charts that are 3 years in length instead of 3 months, and each one of these candles represents 1 week in length as opposed to 1 day. They do still represent the same 4 U.S. equity indices. And as it stands right now, the only kind of odd man out is the Russell 2000. Russell 2000 continues to have what's known as a death cross, or a bearish crossover, however you want to describe that. And that's why we have that background color pink. Whereas the background color up here with the Dow, the S&P 500, and the NASDAQ are all green, meaning that we have received positive crossovers or golden crosses on those 3 indices here within the last few months. So again, it's one more sign that the Russell 2000 is our lagging index. It's the one that just refuses to exhibit as much strength as the others. Perhaps that's on the horizon. Then again, maybe it's a warning sign. A lot of times it happens to depend on geopolitical news like the trade war, or what's going on with various earnings reports and different things like that. Speaking of which, I wanted to quickly show you here on an earnings report perspective. Had some really nice movers here today. In fact, I'm looking at Lululemon. This is ticker symbol LULU. Big yoga wear company based out of Canada, was up 14% here today after reporting their earnings. And then we also had PVH, Phillips Van Heusen, that was also up 14% here today. So a couple of really big winners there in the retail space. In fact, maybe it'd be worthwhile taking a look at what's going on with XRT today. Remember, you can track retail through XRT, and it was up a nice healthy 0.4% here today. So all of a sudden, some of those retailers are coming to life. Keep your eyes on those. Also, while we're having this conversation, I wanted to kind of review a stock that we had placed a trade on in this particular presentation last year, and that is Starbucks. If we wanted to take a look at Starbucks, let's just pull up a chart 4A for this conversation. Here is Starbucks. And let's pull up a one-year chart on this to get a good feel for where we've come from. So this is Starbucks, and wanted to bring it up today because one of my students in my question and answer class brought it up and kind of jogged my memory of it. We actually still have this trade going on. And when we initially placed the trade, it was last year in the summer. I think it was late June. So think of it in about this time period over here when we started to get these oversold cluster signals. So one of the trades that I presented in this market outlook video was to purchase a call, a long call, a leveraged instrument that benefits if the security goes higher. Now, obviously, you can see that stock has gone from about 48 bucks up here to about $74 at this particular juncture. Now, the nice thing about a long call trade is you do have limited downside risk. Essentially, the amount of money that you purchase that call with is what you have on the table. You can't lose any more than that. On the other hand, you have the ability to make multiples of your money. Now that sounds really good on the surface. Don't get me wrong, the idea of making hundreds of percent or the ability to lose a maximum of only 100% does have its appealing elements. However, keep in mind that leverage does cut both ways. The vast majority of calls that are purchased are often losing trades because when you buy a call or a put, those are trades that lose money in time decay. Remember, when you buy a stock, some of you might have bought Starbucks. In fact, we did in my dividend growth investing class around that same time at around 48 bucks. Remember, you're not losing money every single day that you own the stock itself. But when you buy a call, you are losing money every single day on that aspect of the options pricing model. So what you're hoping to do is have the delta, the upside directionality, overcome the loss that you're going to experience in time decay. Now that will only happen if the stock makes a pretty big move to the upside, and fortunately for us, that's exactly what happened here on Starbucks. So one thing that I wanted to do is kind of make an adjustment in our position. You'll notice that currently our position is here on the 5750 calls on Starbucks, and that basically is 295 days until expiration. Remember, we did this one a little different because we wanted to make it a long-term bet on Starbucks at that particular juncture. The reason we were interested in Starbucks at $48 is because it had a 3% yield back then, which was very rare for Starbucks. So we decided to take advantage of that through a long-term option known as LEAPS, and that's actually out to January of 2020 here. And so that's our current position here, but you'll notice that our delta is at 84. Generally speaking, we start to look to roll our delta on long call trades when we get to about 84 to 86, somewhere in that vicinity. So we'll go ahead and kind of go forward with that thought process here tonight, since I'm not with you every single day. So if it were to get to 86 tomorrow or on Monday, I wouldn't be able to highlight this. So this is close enough. So we'll go ahead and place this trade. Notice that this particular instrument is trading for somewhere between $17.65 and $17.95. What we try to do when we roll it is we try to basically sell the contract we are currently the owner of, and then with part of that money, roll it into a new contract. The new contract we typically look for is a 70 delta. In this case, we have a delta close to that at about 68, so that's the one that we'll shoot for, and that is your 6750 call right there. So basically what's happening on this roll is we're eliminating some of our risk on the trade. We'll get to that in a second because technically we don't have any risk on this trade. But nonetheless, if this was a one-off standalone trade, we're reducing our risk when we are rolling a long call situation right there. So we're selling this 5750 and we're using part of the proceeds to continue our philosophy of Starbucks in an uptrend by purchasing the 6750 calls instead. Now in doing so, we're selling something that's worth over $17 and we're buying something that's worth less than $10. So that's where we're starting to see some of the benefits of this leverage to the upside. And remember, this is not the first time around that we've done this. We also rolled this contract in November In fact, I think I got that pulled up here on the monitor tab here just to kind of jog your memory. So here was the initial trade. I talked about it in the video on June 28th, but of course the order doesn't go in until the next day. So the trade actually got filled here the morning of June 29th. We purchased the $45 strike for January 2020 for $7.50. Fast forward about 5 months to November 7th, and we rolled that contract the first time by selling the 45 call for $21.90. And then we used part of those proceeds to roll it to a new call of $57.50, and we spent $11.95 out of our pocket for that. And that's what brings us to today. Now we're looking at selling this contract that we currently hold, the $57.50, selling that one, and then buying a $67.50. Now, they do a pretty good job here on the account statement to show you some of those credits and rolls, but I do know that I've had students in the past that get kind of confused by some of that as well. And so I did want to also bring up this quick little draft here that I put together to make it a little bit easier for you to understand what's taking place and what are some of the benefits of buying calls occasionally. So again, our initial trade was back here late June. We bought the $45 call that expires in January of 2020. We bought it originally for $7.50. If we close that trade down rather than rolling it, we basically sold that for $21.90. We had a net profit of $14.40 per contract. So on our initial $7.50, we basically doubled our money if we would have stopped the trade right there. But we didn't. We continued to roll it because Starbucks continued to be in an upswing. So on November 7th, we basically rolled it to the new strike. We rolled it from the 45 to the 57.50, again sticking with the same expiration period in January of 2020. So for that, we had to pay a debit out of our pocket of $11.95, and then that's where we're going to be selling that contract today for $17.75. The net profit we're receiving out of that roll is $5.80. Now when you add those two up, $14.40 and $5.80, the total profits of those two trades, if we were to shut the trade off right now without continuing to roll, is $20.20 per contract, or approximately a 270% return, nearly tripling our money there. That's if you wanted to shut the trade down right now. Now, many of you are probably thinking, well, doesn't Starbucks look pretty strong? Wouldn't I want to continue to benefit from that upswing in the price? Perhaps. Some of you might say, well, the stock's getting a little bit rich, its valuation isn't where it once was, etc., etc. But for those of you that are more momentum inclined, that's where the continuation of the trade can be a benefit. And so that's what we're going to do here tonight by rolling it to the new strike. Again, staying with January 17 of 2020 expiration period, but we're going to roll it to the 67.50. Now, in order to do that, we have to tap into this $20.20 of pure profits we have up until this point and take a debit out of that of about $9.90. So keep that in mind. That could go spectacularly wrong. If Starbucks came out tomorrow, there was some sort of an SEC investigation and the stock opened up at, I don't know, $50 per share, that $9.90 would dwindle dramatically right out of the gate. So there is that risk that we lose part of the trade. But like I mentioned right down here, this trade which continues to offer upside potential, right? If Starbucks continues to go up, we might continue to roll this in the future with more and more profits. But right now it's already considered risk-free because the worst case scenario is that we lose all $9.90 out of this most recent roll if Starbucks falls dramatically from here, which is probably not going to happen. It might fall, but not dramatically, so we might still retain part of it. But nonetheless, we are risking $9.90. But if that occurs, we still end up making $10.30 of profit per contract from our initial $7.50 call purchase. In other words, our worst case scenario at this point is that we still end up doubling our money at a bare minimum, probably even better than that. So these are really fun trades. They're not all going to work out this way, but this is the reason why you would want to be a call buyer on occasion, used in a limited sense, even though you know that time decay will work against you. It's in situations where you think this type of move is in front of you. And remember, this isn't some sort of new Bitcoin company or marijuana company or some really speculative type of a stock. This is Starbucks, one of the largest restaurant companies on the planet. And if it makes a move like this, long calls can be truly beneficial. So I wanted to take a moment to kind of spend some time doing that because I know some of you still have a little bit of questions around the idea of rolling and what it is that you're hoping to accomplish, et cetera, et cetera. So let's go ahead and complete that roll now. I'm coming down to my position down below. I'm going to right click on it and I'm going to go to create rolling order right here. And I'm going to choose this one that talks about a calendar spread, and we'll change that after the fact. So I'm going to click on that. That loads up our trade down below. Just to verify, we are selling the 57.50 call that we currently own. However, on that top line there where we're going to buy another one to complete this roll, we do need to adjust that. So in the expiration period, I'm going to hit that drop down, and I'm going to change it to the same January 2020 strike, so we stay within the same month there. And then in the strike price, that's where I'm going to choose the 67.50. 67.50 call. And remember, we chose that because we're rolling to the 70 delta, which was the 67.50 call. So again, selling the 57.50 call and buying the 67.50 call, we're going to receive a credit of $7.88 in order to do that. I will put this in as a good till cancel order just in case it doesn't get filled first thing in the morning. Confirm and send. Everything looks fine. We'll send that one in and hopefully it gets filled tomorrow. And we'll continue to have this conversation, ideally, if Starbucks continues to go up. All right, let's get back on track with a little bit more chart analysis, then I'll show you what our trade application example is on the day. Let's talk about chart 4E, which is the intermarket analysis 12 grid here. And as this pulls up, as a reminder, the background colors of these charts will change either pink or green depending upon whether we have a bullish or bearish intermediate posture using the market forecast technical indicator. One of the things that has been on everybody's mind here recently, it seems, is interest rates. You'll notice that TNX has completely fallen out of bed here in the last couple of weeks. And of course, the flip side of that is bond prices are surging with TLT directly below it. So that continued to a degree today with the bonds going up. However, interest rates did finally start to stabilize a little bit. The interest rates had been down for basically 4 days in a row, so they were up just a little bit here today. And remember, those two aren't perfectly opposite one another because the TNX specifically addresses the 10-year Treasury yield, whereas TLT technically covers a wide variety of long bonds, not just the 10-year bond, but it might cover the 30-year bond, et cetera, et cetera. But generally speaking, you will see those two kind of act inversely to one another. So that's really the big story that we've been dealing with here recently, and it's caused a lot of havoc with financial stocks in particular, and it's allowed stocks like utilities and REITs to hold up maybe a little bit better in the opposite sense. Another thing that is worth mentioning is that the US dollar is trying its best to come up here and make another rally attempt. Notice that UUP is now back up above that rising moving average again. Now where we find ourselves is about at the same territory where this thing was trading on March 7th, so perhaps there'll be a little bit of resistance in that area. But generally speaking, this is doing its best to kind of retain that set of higher highs and higher lows. And so of course the US dollar is important to a lot of things, especially commodities, and you'll see here that gold took it on the chin here today as a result. Remember, gold is priced in US dollars, so when the US dollar is strong, a lot of times the gold or other commodities might be weak as a result. So gold was down significantly, down 1.61% today. Ag commodities were down 0.36% today. Both of those have bearish postures. Crude oil held up a little bit better, basically flatlining today, remains above a rising moving average and has that bullish posture. As we look at some of the foreign markets now, notice that we have a clean sweep to the downside for the bears when it comes to foreign stock markets. I know this was a conversation that David was having today for his portfolio management class that he conducts here at Market Scholars for premium Market Scholars members, and having that conversation of which foreign markets should we be switching our longer term allocation into, and which one should we be switching them away from. But the sad truth is right now they all have a bearish posture. Some of the charts look a little bit better than the others, even if they do have a bearish posture. One of the more interesting ones appears to be China. We had a nice up move out of FXI today. It was up 0.78%. And although it does have that bearish posture, you're still close enough to that rising moving average right there that it doesn't give you the impression that there's major supports that are being broken along the way. Right? That is a little bit more of a concern with Brazil over here. We have broken support. Russia's holding up a little bit better near that moving average. India is as well. So some of these areas are holding up better than others. I would say that Brazil is probably the one that is maybe the most concerning right now because of those broken support levels. I would also say that South Africa is a little bit of a challenge here because we're basically trading at 2.5-month lows on South Africa. Many of the other charts, despite having a slightly bearish posture, are actually trading in the upper half of their 3-month ranges. Let's now take a peek at what's going on in the United States. And that would be chart 4G. These are the sector 12 grids right here. And you'll notice that the charts on the bottom are the ones that are holding up a little bit better. And they're placed at the bottom intentionally. Those are the more defensive, aka interest rate sensitive types of areas. And as I mentioned before when we were going through our intermarket analysis 12 grid, with bonds going up and interest rates falling recently, it gives things like utilities, real estate, and even sometimes staples an edge in that type of market environment. It's just the way that macroeconomics works. So those are the three that retain their bullish intermediate posture. It is worth noting the utilities struggled here today. Interestingly enough, staples and REITs continue to do well, but utilities did have a little bit of a give back today. Nonetheless, they remain in an uptrend with a bullish intermediate posture. Healthcare sometimes can be used as a defensive instrument, sometimes it's not. It really kind of depends on what's leading and lagging. Right now, it does seem like a lot of those health insurance companies are some of the laggards within healthcare, and those are the ones that don't typically have big dividend yields. You think of stocks like United Healthcare and Cigna, those types of companies. They usually have dividend yields that are less than 1% in many cases, and so most investors don't view those the way that they would view the staples, utilities, and REITs. Even though healthcare itself does have some defensive characteristics, they're not necessarily known as much of an interest rate sensitive group right there at the same time. Otherwise, we do have a lot more pink on the board here than we've had in recent months. So we do want to be aware of that and keep our eye on various trends out there. I mentioned financials before. Here's what I was referring to. XLF really fell apart here about a week or so ago, even broke that support. Notice how that looks different than most of these other charts, that while they might have a pink background, their price action hasn't been disastrous. It hasn't been a whole bunch of broken supports across the board. Financials, that has been the case. We saw a clear breach of that support level where we bounced last time on March 8th. So be a little bit more leery there around those financial stocks. All right, let's talk about our trade application example for today now. Let's go back over here to chart 4A. And I wanted to pull up a stock that, as I mentioned in the intro, has gone absolutely nowhere. This is Pfizer. And this is the 3-month chart here, but I'll even widen it out to a 6-month chart. As you can see, this has been like watching paint dry. You know, basically over the last 6 months, it's up, or actually down 3%. Over the last 3 months, it's up 0.24%. So, you know, that gives you a sense of the range. Now, 9 months and a year, it's got a little bit more upside there. But over the last 6 months, this thing has largely just been tracking sideways, you know, between a range of, let's call it 45 and 40. And so those are the types of charts that you might want to focus on for iron condor trades. Remember, an iron condor is where you sell a bear call spread on the upside and you sell a bull put spread on the downside to kind of create this range in the middle where if it continues to track sideways, your trade will benefit. But also remember, if the stock does break out big one direction or the other, the iron condor trade can suffer as a result. We kind of had that conversation today in my question and answer session. But this particular stock, if you expect it to continue to go sideways for the foreseeable future, then perhaps an iron condor could be useful. So let's kind of examine how to apply that from an educational perspective by coming on over here to the trade tab, pulling up Pfizer, And I'm going to look at the May contracts with 50 days until expiration. These are your normal monthly May contracts. Typically, what I'm going to do is I'm going to look for a delta that's close to 20 to sell. So notice over here on the put side of the equation, that leads us to the 39 put. On the call side, the 20 delta is a little bit trickier because you have a 26 or a 15. Neither one of them are really right next to 20. So I did check this before I started the presentation, and it looks like the 44 will be the one that I can kind of work to my liking. So, obviously if you're willing to accept a smaller return, you might focus on selling the 45 instead. But in this case, I'm going to focus on the 44. So we'll be selling the 39 put, and we'll be selling the 44 call. Now, in addition to that, we'll be buying the 37 put as part of a kind of a built-in hedge in case we're way wrong, and we'll be buying the 46 call for the same purpose. So that's what creates your iron condor. So notice those are $2 wide iron condors as opposed to $1 wide. So in order to load that trade up, I can come on over here to my 39 in May, which currently has a bid of 32 cents and an ask of 35 cents. I'm going to right click on that and I'm going to go to sell iron condor. That loads up our trade down below where I can start doing some of my adjustments to it. So down below here is the sold put, -1, $39 put. And for that, on the bottom side where it says +1, I need to change that to 37 if I want to do that $2 wide. On the top part where we're talking about the calls, we're going to sell the 39 call, and we're going to buy the 37. So I need to change that from 41 to 37. There it is. All right. Actually, did I do that wrong? I might have done that wrong. Hang on just a second. On the call side, we need to go higher than that. My apologies. Kind of got myself confused there for a second. So let's try that again. 44 and 46. Those were the two that we were looking at. Where's 46? There it is. All right, that's much more like it. I was going to say to myself, boy, that credit and that debit seemed a little bit odd over there a moment ago. So this looks much more like it. A 50-cent credit out of a $2 wide. That should get us our 30% return on risk. Now, that's just a ground rule or a guideline. You don't have to use it. David and I oftentimes do. We want to make sure our spreads are getting at least a 30% return on risk. But obviously, you can adjust as necessary whatever your rules suggest. But in this case, if you wanted to figure out what is your return on risk when you pull up an iron condor that looks like this, remember you can come on over here to the confirm and send button and click it once and then get your calculator out and take whatever max profit they're showing you, in this case $50, and divide that by whatever max loss they're showing you, in this case 150. So 50 divided by 150 tells you you've got a 33% return on risk in that particular case. Now, obviously, you would adjust the position sizing as well according to your account size. We're just doing this for educational purposes, so I'll just leave it at one contract for the time being. But that's kind of the basic idea. Also, notice here where your break-evens are on this trade. 38.50 is your break-even on the downside, and 44.50 is your break-even on the upside. So I'm going to send this in and we'll see if we can get filled first thing in the morning. And then I want to show you really quick on the chart where that range of the break-evens would be on our trade. So let me get a drawing tool out here. Let's just use a price level and let's draw one line up here, and then I'm going to right click and edit the properties and change this to 44.50, which is where our top break-even was. And then I also want to draw another line. Let's do that again. I need to select it again. Hang on. There we go. And on the bottom side, I'm going to right click, go to edit properties, and take this down to 38.50 and hit OK. So that kind of gives you an idea there on your range of where you want this thing to fall. You can see for the vast majority of time in the last 6 months, it's traded within that range, with the exception being right up here and right up here. So this one does seem to be giving you a little bit more wiggle room to the bottom side. So perhaps as we enter May with these contracts, remember that will be when people will be talking about sell in May and go away. So if you think that the stock market is going to struggle on a relative basis, then this particular trade might benefit you because it gives you more flexibility for the stock to go down than it does to go up. So if you are somebody that is wildly bullish right now, you might choose to adjust the strikes a little bit, and rather than, let's say, selling the 44 up on the top side, maybe you sell the 45 and you adjust your bottom strike up from the 39 to the 40 instead, right? So there's different ways that you can achieve that, but that's your basic idea behind a neutral iron condor on Pfizer here this evening. All right, well, I want to thank you for joining me here tonight. As always, we want to make sure that we're tracking some of the most important developments of the day. That happens to be China, interest rates, Lululemon, all these types of things that are going on here. But we want to make sure that you're getting a good experience out of these videos. So if you do, make sure you click like and retweet there on Twitter for us. And David will be back with you tomorrow. Have a great night, everybody. Take care. Bye-bye.